What or who can save this market now? That's the question that we're asking ourselves today on Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. We had the first batch of major event risk here for the week. Earnings from Nvidia are with us, as well as minutes from October's FOMC meeting. And we have something to chew on, finally. The reaction in the markets is an interesting one. So what we're going to do here is break down what's occurred, take a look at what's coming up next, and see if we can make the case here that perhaps this relentless selling that we've seen across the markets this week, and really starting almost 4 weeks ago on October the 29th, whether that's something that's finally starting to run its course or if there is more ahead. So here's a look at the way that the markets performed today. We can see a tepid rise for stocks, S&P up 0.38%, NASDAQ up a little bit over 0.6%. A slight uptick in the yields. Seems to be less about this or that view on policy. In fact, yields have been a little bit disconnected, especially at the long end, from the very immediate policy questions. They seem to have benchmarked that earlier. And instead, a reflection of the risk-on mood. Very cautious risk-on mood, but a risk-on mood nevertheless. At least the aggression of the risk-off move earlier in the week and last sort of tail end of last week, at least, that has waned here somewhat. Gold idling with this kind of correction, a little bit higher, again, starting to add evidence into the pile that gold is no longer a foil for the dollar or a foil for yields, but is more like a speculative asset with its own speculative narrative, not necessarily the same speculative narrative as stocks. In fact, we might be used to a risk-on, risk-off narrative going back, really all the way back to the '08 crisis, where assets go into either the risk-off or the risk-on bucket with nothing in between. But now we find that in sort of the post-COVID, increasingly deglobalizing world, there can be multiple speculative narratives that are not necessarily correlated at the same time. And gold seems to be one of those. So it's up here on what seems to be a sort of day for a breather on the risk sentiment front after aggressive selling. Dollar is up across the board here after those FOMC minutes. We'll talk about those in a moment. Euro is up 0.5%. Yen is up almost a full percentage point. That's after some very dovish comments from Takaichi Sanae, the new prime minister of Japan. And what we, of course, were looking for there continues to be the sort of story du jour. When she went and got this job, we sort of highlighted that who she is a protege of former Japanese Prime Minister Abe and Shinzo Abe, and that in that she is quite dovish on monetary policy, very expansionary on fiscal policy, and what we end up with is this kind of rhetoric that has been weighing on the yen really since July. And not surprisingly, we continue to see as more of this kind of commentary comes out, we get still more of the same. The news today was that the new administration will deliver a huge spending package and that it's going to try to back those by low interest rates, which essentially means that we are probably looking at the BOJ, which is not strictly independent from the government when push comes to shove, that it's going to get restrained in whatever rate hike intentions it might still harbor. Bitcoin down 3.52%. The meltdown in crypto continues and continues to tell a story of eroding risk appetite, especially at the high beta, sort of further end of the risk spectrum. And that, of course, speaks to the larger story here. The idea that the markets are still deeply uncertain about what's going on, as reflected in Fed policy expectations. In fact, as we take stock of this kind of modest rebound in stocks today, consider how we're performing so far on the week. We're down almost 1.5% on both the S&P and NASDAQ week to date. So since the opening on Monday, rates are down because risk aversion, and so bonds are higher. Gold is down because, again, it is a speculative instrument now, apparently. The dollar is up across the board. Strong gains against both the euro and the yen. Bitcoin is off 5%. Consider that in the context of what we saw last week, which was a stall for stocks after aggressive selling. And for the dollar, which, again, was a little bit more digestive. For gold, that was a little bit more digestive. For Bitcoin, though, clearly speaking about intent. Bitcoin is, again, down 9.3%, down 5.7% the week before, and on pace to be down over 5% this week. So the unraveling in risk sentiment, at least as reflected in capital rushing for the exits in the far edges of risky asset universe, that is Bitcoin, that really speaks to where sentiment seems to be, and perhaps even more clearly where retail sentiment seems to be, because professional sentiment has been quite negative for a while. But retail sentiment has really helped to underpin markets and has been very rosy, and perhaps that's finally starting to show cracks. A big reason for the weakness that we saw earlier today, before the markets kind of evened out going into the Nvidia earnings, which we'll talk about momentarily, was this bit from the Bureau of Labor Statistics here. Almost said Bank of International Settlements. Not that. This is telling us that November's, or rather the November release of October's jobs report canceled. We are not going to get October's jobs data, and we are going to get November's job data after the Fed decides rates on December 10th. That's been pushed from December 5th to December 16th. In other words, the markets are not going to get the kind of clarity ahead of the Fed meeting. And of course, the Fed itself is not going to get the kind of clarity ahead of its meeting that it might need to raise rates or cut them or to do anything at all. And of course, the probability that they were going to raise was never really on the table. But when we look at Fed policy expectations going into today, they'd been hovering at 50-50 for December. And so really the market didn't know what the Fed was going to do. And that, of course, was the feeding of the uncertainty personified that the markets have been so concerned about. Now, we get this announcement today, and not surprisingly, the market's readout is, well, this is just more uncertainty for longer. The Fed really doesn't know what it's going to have to do, which probably means it's not going to do anything. We get a similar message from minutes from October's meeting. We can see here most officials see rate cuts over time as likely. In other words, the bias at the Fed is still dovish overall. Several officials said a December cut could be appropriate. However, many others felt rates should remain unchanged for the rest of the year. In other words, many is greater than several. So the consensus on the board is probably now to hold rates steady. At least as far as the minutes were concerned in October. Now, we did this exercise as I was writing up the preview for these minutes, looking at what Powell said on that fateful day on October the 29th that seemed to summarize these views and whether things had changed. And very tellingly, what Powell said at that press conference where he scared everybody was, look, there were strongly differing views about what to do in December. September and October were risk management cuts, and that's not the case going forward. We don't know what data we're going to have in December, and of course now we see that it isn't much. If there is a significant change in the economy, we will pick that up, ostensibly, if the market starts to come undone, if the bond market starts to scream, if credit spreads start to widen out in an untoward way. Yeah, the Fed would know something is wrong, and then they would act. Have we seen that since this meeting on October the 29th? No, not really. Meanwhile, we have less data than even we thought could be the case, with the government shutdown ending and with the statisticians back to work. So what's the upshot? Well, to quote Powell directly, what do you do if you're driving in the fog? You slow down. And so that's essentially what we seem to be getting in these minutes. And on reflection, since this meeting occurred and up until now, has the validity of any of this changed? No. Doesn't look like it. Doesn't seem like anything has really moved. Most officials warned that additional rate cuts could risk embedding higher inflation. That tells you where their bias is. Several warned of a possible sharp, disorderly drop in stock prices if there's a sudden reassessment of AI-related expectations. Not surprisingly, we're starting to see a little bit of that, but that's not exactly a controversial opinion. We see also that against this backdrop, Fed staff have slightly upgraded their outlook for GDP through 2028, which again just diminishes expectations for rate cuts further. And so if we look at the probabilities now as they stand for December, we're at 34%, call it, for the probability of a cut, 66% for standstill. Now, we did get a little bit of a pop from Nvidia here after the close, so that might give sentiment a little bit of a fillip when we come back and see the way that the cash equity open behaves itself once we get there tomorrow. That's after we get about a 3% beat on both EPS and revenue from Nvidia for the third quarter. Now, this was inside their usual surprise range. The range was between 4 and 10%, going back to the first quarter of 2024. That's when Nvidia kind of evolved from double-digit quarterly surprises to single-digit. And what we end up with here is within that range. So Nvidia could have reported up to $1.38 a share for EPS, and that would be kind of within the realm of what has been normal. They reported $1.30 against expectations of $1.25. So we're looking at ostensibly a slightly better than expected result. That's given us a little bit of a lift for the shares here. We'll see if that does any more to buoy sentiment. Obviously, Nvidia is a giant pocket of market cap, so we're getting a little bit of a lift for Bitcoin after hours here. We're getting a little bit of a lift for NASDAQ futures. The key question really will be whether this holds up beyond this initial reaction, because what we've seen, again, since October the 29th, is that the market has shrugged off good news. It usually takes between 24 to 48 hours to digest that good news, but after that, the good news fades. The reopening of the government after the shutdown last week, beautiful case in point. We get about 2 days worth of upside, then everything stops, and we end up ultimately with a goose egg of a week. So we get this lift to sentiment here, but it is unclear that it is going to persist unless we get some sort of a breakthrough for the Fed. In that sense, we are going to get a belated September U.S. jobs report coming out before the cash equity open tomorrow. The expectation is that we're going to see 50,000 jobs added in September with a jobless rate of 4.3%. How impactful this is on anybody's reckoning of what the U.S. economy is doing, including that of the Fed, is unclear because, of course, this is tremendously dated now. But in so much as the markets just want a common yardstick, it will still probably end up as a sentiment barometer of some sort. If we get a weak number, I think the expectation is going to be that October probably was weak also, even though we're not going to know anything about what's going on for the official figures, as we saw for October, until we end up in December the 16th, and then maybe as the November numbers come out, October will be backfilled. So we'll see. But this should be an interesting sort of a barometer. It probably falls too far in the rear view mirror to tell the Fed anything actionable. If it is very soft, the markets might reason that the Fed could extrapolate this to get themselves to cut in December, because, of course, the weakness of the labor market has been their main hobby horse here. But nevertheless, this is very old, and it is unclear that the markets are going to embrace some sort of clarity out of it. If ultimately we are now, as we see on the expectations front, about 33.66 in favor of a hold, and there's a soft NFP number, maybe we get back into the vicinity of 60-40 or 70-30 the other way. Maybe we get back to 50-50. If we get back to, let's say, 60-40, 70-30 the other way, does that change anything? Well, no, the markets were already there last week. They were already there going into this week. So it doesn't necessarily suggest that sentiment is going to get much of a lift. But it will be interesting to monitor, of course. Later in the week, on Friday, we're going to get a much timelier indicator of growth by way of the S&P Global PMI numbers. They're third party and not dependent on the U.S. government shutdown, so they should be much more telling for where the market might see the business cycle near term. Expectations are for a slight slowdown. We can see that on the composite PMI number there. Of course, as ever, these are centered around 50, where that's neutral. Above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what we find here is, essentially for the U.S. composite number, a move from 54.6 to 53.8 would be growth, but at a slower rate. So we'll see how that goes. We have seen growth rebounding here after the tariff shock at the start of the year. Here's that tariff shock right here. Here's January. So we get a big sell-off, or a big decline, rather, in these PMI numbers, showing the level of concern with the tariffs since, tellingly, April. By the way, this looks very much like the stock market, especially the equal weighted versions of the S&P and the NASDAQ. Not quite the regular versions, because, of course, they're so skewed by the amount of market cap in the Magnificent Seven. But I digress. We're back to these heady levels for growth at the end of 2024, which were themselves multi-year highs. So it looks like things are generally okay, and it looks like these incoming numbers are going to be about where the markets have seen growth. But of course, from the Fed's perspective, this is not a recipe to rush into aggressive easing. For their part, the markets have mostly concluded that we're, as we just saw, unlikely to get something now in December. But for next year, we're looking at almost fully priced in expectations for 3 cuts. 72 basis points now on the table, which of course contrasts dramatically with the Fed's own forecast. We can see from 3.6 to 3.4 for next year, that's just 1 cut. So the question really here starts to be, well, the markets are already very, very dovish relative to expectations for next year. What could the Fed really do with stale September data to tell the markets, hey, we're coming your way, stop freaking out? Not very much. And so what we're setting up for in December is not only a cut that doesn't occur, though the markets want it, but maybe also a forecast, because we're going to get this summary of economic projections updated again in December, that doesn't line up with what the Fed is saying at a time when, again, they want more cuts. Strong PMI data wouldn't help this either. So if the problem for markets is that the Fed is not easing fast enough, none of what's directly in front of us seems to be helping or seems like it could be helpful. Indeed, if we take a look here at what's happened, it could not be clearer. Here is the last Fed rate cut. This is the October 29th move right here. Notice this is also where the stock market tops. That's the S&P 500 right here. And that's arguably because of what Powell says after this very move. We can see here since then expectations have been relatively steady, and that's even as the outlook for the rest of this year, that is December, has unwound because the market is really holding on to these cuts for next year. But if that's not going to hold up, if the Fed is not going to come fast enough the market's way, well, then this disappointment that we've seen is probably just warming up here and has more room to keep going. Meanwhile, for the dollar, one might say, well, the dollar should be declining. After all, we've started a rate cut cycle, but as you can see, the start of that rate cut cycle also marked the bottom in the dollar after it retested July's lows in mid-September, and that's because arguably this much has already been priced in. And what this dollar move is more risk aversion, and the dollar reclaiming its mantle as a haven asset after this relentless sell-off in the first half of the year, a record-setting one, as a matter of fact. And so what we end up with is a dollar that continues to march higher. Now, from a positioning perspective, I've updated some of my exposure here. I'm still a little bit long gold at these levels, basically right around here, looking for maybe a bounce if the market starts to extrapolate that it wants rate cuts further downwind. That would, of course, require for gold to transform itself back into a dollar and yields derived kind of a creature rather than a sentiment derived one. We'll see if that manages to happen, but so far I'm holding a little bit of a long exposure here. We'll see what happens. I'm back on the short side of most major currencies. I flirted a little bit with being long the euro and the pound. That did not work out, so I quickly pulled up anchor on those positions, and I have now flipped back short. Short the pound, short the euro, been short the Aussie since the beginning of this week again, and been short the yen since July. That's a position that continues to work. I never took it off as I was cleaning up my other dollar exposure last week and this week. So I'm still very much long the dollar, just much more one-sided once again in where I'm sitting. Still short risk. Bitcoin continues to sink, so I'm still holding on to these put verticals that I put on. They're one of the bedrocks of the portfolio now with how they've performed. Bitcoin down again today, so IBIT's off 3.74%, so I'm going to keep holding on to these. There's plenty of duration in them still. I put on a short on IWM this week, looking for the Russell to also come down. That's been the latest addition to my risk-off exposure here. Of course, still short the S&P through SPY and have been since that October 29th Fed meeting when Powell said the magic words. So that continues to work as a put vertical here. Still long the long end of the bonds. Seems like they're not really responding to Fed policy expectations as readily, and maybe that starts to speak to the prevalence of risk aversion, as well as the idea that rates are going to be expected to come down later, if not sooner, and so the cuts will shift deeper along the curve, and that will keep bonds bid on the long end, even if the front end has to suffer a little bit. Still short crude oil. It's very slowly going nowhere, but the bias is still seemingly down, and the position is almost at break even. It's not really up all that much. And so I'm going to be continuing to look for what happens here. As you can see, we closed today just under 71, and the sort of most aggressive of sort of the earliest of these positions is based from 71 and 70. So this is not a trade that's making a ton of money. It's basically where it started. So we'll see how it goes, but so far crude oil still looks kind of soggy. Of the long-term exposure, a very, very long-term position with expiry at the end of next year for MSOS in the event that cannabis comes up in the midterms. And the long-term holding now, I've been sitting on it for months and months. EWZ, the Brazilian stock market, I have calls on that. That's been working for a few months now, and I've got expirations here at the end of the year and early into next. If it keeps working, I'll roll it. And that's what I've got on here, and that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm also writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.